you are going to see a crack in the bond market.
Think the 2008 crash was bad? This bond market bomb is 10 times bigger, and it's set to hit investors and business owners first.
It is going to happen.
And it won't be a crash, it'll be a lockout.
We borrowed and spent $10 trillion from 2020 to today. We also bought $4 trillion of your securities. Those numbers are true globally. The QE of us was $8 trillion, the QE of the rest of the world was another $8 trillion or something like that. You're talking about huge sums of money.
Jamie Dimon just told you why, but nobody's listening. Let's fix that in the next 8 minutes, because here's what's happening now and why it matters for your next deal.
I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine.
Jamie Dimon isn't some YouTube doomer. He's the king of Wall Street. But his warning, it's not new. In 1994, Citigroup's John Reed warned of irrational complacency weeks before $1.5 trillion vanished overnight. Here's why that matters to you. When Wall Street's biggest players start warning, it means the money you need for deals is about to get a lot harder to find. History doesn't repeat, but it rhymes loud. And here's what that means. I always thought that was funny, but here's what it means. The US national debt, $37 trillion. That's $107,000 for every American, including your kids.
You know, these are very large numbers.
So translation, the government is broke. And when governments go broke, they make it harder for everyone else to borrow money.
You're talking about huge sums of money. We don't really know the full effect of that.
For years, the Fed flooded banks with cheap money. That's why loans were easy to get. But since 2022, they've pulled $2.1 trillion back out of the system. Less money in the system means less money for your deals. But here's the gut punch. The warning light that's predicted every recession since 1970, flashing red for 2 years straight, a record. And Dimon isn't guessing. The last bond market collapse erased $1.5 trillion. But today, the market's 24 times bigger. $37 trillion debt bomb versus $4.8 trillion in '94. So if you do the math, a $4.8 trillion problem caused chaos in 1994. What happens when a $37 trillion problem explodes? Your funding doesn't just get expensive, it disappears. The government's response? But hidden fact, net interest will hit 13.55% of federal spending in 2025. We'll spend more on debt than defense. And here's the scary part, if it could get scarier. When the government is spending more on debt payments than the entire defense budget, guess who they squeeze for tax money? And guess which loans banks stop making first? Yours and yours. A 1% rate hike used to cost us $360 billion. Now, 10 times bigger powder keg. But what does this mean for you? Someone actually trying to get ahead? Well, let's zoom in. Meet Leonard. He's not new, mid-40s, closes deals, mastered off-market deal hunting with old-school hustle and new tech tools. He's hungry. He wants passive income so he can stop hustling deal to deal. He's a big fan of the channel. So he finds the perfect fixer-upper. He negotiates hard, locks in a killer price, but the bank only funds the purchase. Nothing for rehab or holding costs. He tried to negotiate, but nope, that's not how these loans work, they said. Seller has other buyers. Time's up. Leonard needs funds for everything, now, or he loses the deal. And here's where the system bites. New banking rules just made it 19% more expensive for banks to lend on real estate. What does that mean? Banks have to set aside 19% more cash for every real estate loan they make. So they're making fewer loans. And the ones they do make have stricter rules. Guess who eats that cost? You do. Leonard loses the deal. Watches someone with faster, flexible cash snag it. He's furious. He did everything right. But the money system is built to keep you stuck. But here's Leonard's light bulb moment. He found a different way. 3 months later, he closed 4 deals using private credit while his bank was still reviewing applications. Leonard adapted. Most don't. And Leonard's story isn't rare. It's the new normal, actually. Banks tighten, lending standards shift, opportunities slip. And here's the connection. When the Fed warns about bond market cracks and the government is drowning in debt, banks get scared. Scared banks don't lend. No lending means your deals die. And if Dimon's warning is right, this only gets tougher. Look, I've seen this myself. In 2023, one of my own clients lost 3 deals in a row to cash buyers because his bank slowed down mid-funding. If you rely on traditional money, you're rolling the dice. Real estate works if you play the real game. Most people are stuck, chasing approvals, stacking paperwork, praying money shows before the window closes. And here's the reality. Bond markets are like the ocean. Banks are fish. When the tide, Fed liquidity, leaves, stranded fish die first. That's why we saw regional banks collapse. What this means for your deals? When banks are struggling to survive, your loan application isn't their priority. Their survival is. It's not 2012, not even 2020. Banks are scared. Credit is drying up. And here's the math that kills deals. A 0.5% rate hike equals $180 billion in new interest costs for the government. And when the government pays more for money, everyone pays more for money. The Fed can't unload its $6.7 trillion in mortgage bonds without crashing the housing market. And that means they're trapped. They can't raise rates without destroying real estate, but they can't lower them without destroying the dollar. And even if you're doing creative deals, sub-2, seller financing, all the stuff we love here so much, it's the gap funding, the rehab cash, the marketing costs, and the speed that separates the pros from the stuck. Feel the game's rigged? Yeah, you're right, it kind of is. But here's what most people miss. The game changed, but it didn't end. You just need to know the new rules. Is the problem real estate or the way you've been told to fund it? What if the choke point isn't the market? It's the kind of money you're chasing. Stop begging banks. Follow the smart money, the ones who moved first. I mean, think about it. While you're waiting for bank approval, someone with private funding is closing your deal. If you had that type of funding, would you still be watching deals slip away? Or would you be scaling while others wait for approval? Insiders know this. Private credit jumped to $1.5 trillion. Morgan Stanley says it'll be $2.6 trillion by 2029. And here's what that means. While banks got scared and pulled back, private lenders stepped in with $1.5 trillion. They're funding the deals banks won't touch. The smart money didn't wait for banks. They built their own system. The ones who plugged in, they thrive when markets shift. And in 60 seconds, I'll show you exactly how to tap into this. But first, you need to understand why banks can't compete anymore. They're regulated to death. Every loan they make, they have to set aside cash reserves. When rates go up, they lose money on their old loans. When the Fed pulls money out, they have less to lend. But private credit, no reserves required. No old loans dragging them down. No Fed dependence. They can move fast, lend on deals banks won't touch, and fund the whole project, not just the purchase price. That's why Leonard's Bank said purchase only, while private credit said, here's everything you need. You don't have to play the old lending game. This isn't a secret. It's the new institutional normal. Billion-dollar deals use private credit, and it's open to you if you're moving fast. The proof is in the growth. Private credit went from almost nothing to 1.5 trillion because it solves the problems banks can't. When banks say no, private credit says yes. So what changed? Well, institutions learned that when traditional banking breaks down, private credit steps up. Now you can access the same funding that billion-dollar deals use. This is money for action takers. Bring the deal. Private credit brings the cash. No more only purchase price excuses. No more come back later. No more, that's not how we do it. Real example, Beltway Lending just closed $4.3 million in deals last month that banks said no to. While traditional borrowers waited for approvals that never came, these investors closed deals. Loophole Lending just funded $2.1 million in business credit to help real estate investors and business owners with capital for marketing, for gap funding, for rehab costs and payroll. If you're ready, it's your turn. And here are the warning signs smart investors are watching, while others stay clueless. The first one is the Japan warning. Our debt to GDP matches Japan's 1999 level. 4 years later, it cost them 3 times more to borrow money. Same thing's about to happen here. Then the refinancing bomb. 23% of all government bonds have to be renewed this year. If the government can't find new lenders, interest rates explode. Higher government rates mean higher rates for everyone. The smart money move. While everyone's panicking about banks, private credit is quietly becoming the new normal. The institutions already moved. Don't get left behind. And then the scale difference. 2008 subprime meltdown was 5% of total debt. Today, the refinancing risk is everywhere. Early movers win. And number 5, don't be the stranded fish. When the tide goes out, you find out who's been swimming naked. Make sure you have funding that doesn't depend on the Fed's mood. If you're already doing deals or ready to move fast, there are 2 places that you want to check out. First, Beltway Lending. They do 30-year rental loans with no income documentation, just your lease, 2 bank statements, and ID. I'll put their link in the description. And the second place, loophole lending. They get you up to $150,000 at 0% interest for 21 months with no collateral, approval in 30 seconds, funds in 7 to 14 days. See if you qualify for funding that doesn't make you beg. It's pretty refreshing. And if you're still hunting for your first deal, save this video and come back when you're ready to move fast. But loophole lending still might make sense to check out now. Go get some funds and help you kickstart things. Real estate isn't broken. The old way of doing it is. The Fed is trapped. Banks are scared. Private credit is winning. The bond market crack is coming. So the only question here is, are you ready or are you going to be the stranded fish? Thanks for watching. I'll see you next time. Take care.